Thanks very much. I waited till the last minute on the plane to do these slides because, I was eating candy and stuff. So I thought, in my wisdom on the plane, it might be useful to show you 3 pictures before I start. We've got nice grandma baking cookies. It's a little sad. We see who's not in the picture, so an elderly widow. Then we've got another picture of grandma, which isn't so nice, the famous Livia Soprano. And then that is the steadily depreciating home of Uncle Jesse from the Dukes of Hazzard. And I think it will be helpful to keep these 3 archetypes in mind, okay? Because when I was trained here by Jim Paterba and Peter Diamond, my thinking on reverse mortgage was very much grandma baking cookies. And we have this glaring puzzle, which, as we just saw, home equity is a very important part of wealth, especially for the people we sort of care about from a public policy perspective who only save through a house. And yet, so then you have people, this woman who's got $15,000 in savings and a $150,000 house. She's not, we all know she doesn't want to move out of the house. There's nothing irrational about that. But why isn't she spending some of the home equity before she leaves so she has a smooth rather than a lumpy consumption trajectory? And I think our take on grandma had been, well, she's just not sufficiently clever, and apparently less so over time, to see the benefits of annuities and long-term care insurance and also reverse mortgage. I would caution people, until you have a reverse mortgage, it's not at all clear that you ought to be annuitizing or going into long-term care insurance, because you have this correlation that home equity, life annuities, and long-term care insurance all pay out late in retirement, so you're sort of really loading up on the end if you buy those products without a reverse mortgage. So the original thinking on reverse mortgage, I think, is very much of a consumption smoothing product. And then we also have this take that, you have to pay this giant fee to close a reverse mortgage, something like 6% of the value of your home, which is much more than a line of credit where the closing costs are, a lot closer to 0 than 6%. So not only is grandma kind of not sufficiently clever to take a reverse mortgage, the ones who do take a reverse mortgage aren't sufficiently clever to understand that they shouldn't be paying these horrendous fees. Okay. Around 2011, I started to have a really different take on reverse mortgage, which is more of sort of a Livia Soprano view of the potential borrower. Because if you think about HECM, the way it's structured, there's a line of credit option, which is you don't take all the cash up front, you wait to borrow, and how much you can borrow grows formulaically at the loan interest rate over time. And so if you model the optimal use of a line of credit, it's a massively underpriced default option on the home. So in fact, 6% in fees for many older people, particularly Uncle Jesse, who lives in a market with no land appreciation, it's an underpriced default option. Okay, so that's in the background. People probably don't see that, but wait a second. When were reverse mortgages originated? To a first order, through 2008, every reverse mortgage originated was in Stockton in the year 2007. It was a catastrophe of adverse selection. People actually took reverse mortgages exactly where the default option value was highest. And that's true across housing markets. So you didn't get a lot in Cambridge, but you would have gotten it in, I guess, Dorchester. I'm sorry, that's within housing markets. So not only was it all in Stockton rather than Boston, where prices didn't fall as much, but even within markets, it was the subprime neighborhoods which had the biggest booms and busts where you had much greater take-up. And so you get this problem of, maybe consumers are ignorant, but they don't look so ignorant because they're taking HECM, the U.S. reverse mortgage product, exactly where it's advantageous to do so, because they're likely to die with a mortgage balance much greater than the value of their home by more than the 6% closing cost by a lot. And so, this is a really scary potential borrower who's aware of this default option and seems to exploit it. Okay, the synthesis is I actually think the first view of borrowers is probably closer to correct, and we have what I would call a bid-ask spread. This stuff is terrifying, especially to a private lender. The potential that the loan balance can grow to be greater than the value of the home, and of course these are non-recourse products. And on the other hand, borrowers don't understand the value of that default option, which is quite complicated, and we see that through the main paper I wanted to focus on, because when you have a line of credit, I can't tell you, I don't think anybody can, what the optimal use of the line of credit is. But one thing I can tell you is if your credit line exceeds the value of your home just before you die, you ought to grab all the line of credit because that's free money, the excess of the line of credit over the value of the home. But I see, just to cut to the chase, I don't see any evidence that that's the case. Instead, borrowers seem unaffected in their credit line use by whether their default option is in the money or not when the loan terminates. Moreover, while we saw adverse selection in that the bubble markets saw lots of demand for HECM, there's a huge default value in markets like anywhere in the state of Kentucky, Georgia, the stuff that isn't the coasts, because of the low home appreciation, at least historically. And yet, though the Uncle Jessies of the world, the people living in these rural markets, don't take HECM despite seemingly a very underpriced put. So that's the dog that doesn't bark of adverse selection. And those who do adversely select don't seem to ruthlessly exploit the put option by using the credit line strategically. Okay? So that tells me there is a spread between a very scary default option potentially and what borrowers understand. And not surprisingly, getting a private market going is going to be very hard. The US provides insurance through the Federal Housing Administration, and while HECM is disappointingly small, there's much greater penetration of reverse mortgage in the US than anywhere else in the world that I'm aware of, and I believe the second most penetrated market, despite having started recently, is South Korea, where there's also government insurance, possibly underpriced. Okay, so how does HECM work? And this will help the other presenters. So you have to be 62, or I'm sorry, not must be under, you have to be over 62. Recently, for May-December couples, there was a terrible problem of a 70-year-old husband with a 50-year-old wife. To get HECM, you drop the 50-year-old wife from the title, the old guy dies, and even though borrowers don't have to make payments until they move or die, if you drop the wife from the title, she's not a borrower, and now when the husband's dead, she's got to come up with money which the husband spent, or else she has to leave the home, which is very sad. So technically everybody has to be over 62, but that's been changing. You can get a lump sum or a line of credit. As I mentioned, importantly, the line of credit, the most that you can draw, if I haven't touched the loan until date T years from origination, I get the original loan to value on the original property value multiplied by the growth in interest. So I can always borrow up to how much I would owe if I hadn't drawn on the line of credit at all. So I can always match whenever I want the outstanding balance of somebody who drew everything up front. And that's with an adjustable rate mortgage that moves with the one-year treasury, typically. Okay, there's a rate spread. So you, in the data I have, you are paying a 2% spread over the one-year riskless rate. And you pay closing costs up front. 2% is a guarantee to the Federal Housing Administration, which insures the lender, and other closing costs that I think have actually shrunk over time. Now, a fixed rate mortgage with some semi-lump sum withdrawal is much more popular, having to do with the secondary market. No repayment critically is due until you move or die. That's the important thing. However, you do have to pay taxes and insurance, and believe it or not, people are actually defaulting on those obligations. And I should have said, a key way of reducing the default option that's sort of on the policy agenda, but the step not quite taken, is you've got to require people when they take a HECM or any reverse mortgage to also, when you draw a dollar, draw another dollar to match the tax and insurance and interest payments that would be required so that the loan balance doesn't grow over time and you avoid these tax and insurance defaults. So I'll let Stephanie blow you away with the fraction of borrowers that are defaulting on these loans despite often having a house worth less than they can owe and not having to make any interest or principal payments. Okay, so why is HECM a good idea? If you think about a two-period world, lots of people have wealth that's liquid and housing wealth, and they can choose how much to consume in period one, and they sort of consume the rest in period two. But period two is really loaded up, period two being after you're dead or into long-term care, so the house is liquidated, and you'd be a lot better off possibly having the option to spend some fraction of the value of your home in period one. And again, if you don't have this option, you can see how H over here, which can't be spent in period one, is going to look a lot like long-term care insurance. But HECM is deemed expensive because, yeah, sure, it's nice that you can move some of the housing consumption into period one, but you got to pay 6% for it. But let's think about this underpriced put option. So you got to pay 6% up front, but what do you get? When the loan terminates, if you have, well, it doesn't matter whether you've used the line of credit or not, the default option, because you'll draw the full line of credit before you die optimally, if your house is worth less than you owe. So you're comparing 6% versus the expected discounted value of either, your house is worth more than the loan balance, fine, you don't get any benefit from it, or the loan balance has grown to greater than the value of the house. And you can imagine, what if interest rates go to 12% and you live in Kentucky where there's no home price appreciation? You could be deep, deep in the money before termination. And it doesn't take much, I have a paper on this, it doesn't take much before you can get quite deep into the money. And with no real home price appreciation, I think it's hard to believe that this isn't a favorably priced default option. Okay, and of course, if you're in Stockton in 2007 and you think this home price has been this growth has been crazy and prices might fall 20 or 30%, this is a fantastic product. And just imagine, so you got that Uncle Jesse in that house with no land value. Think of what this provides. It's favorably priced risk neutrally, but it's a hedge against your longevity. This default option is convex valued in the date at which you die, which is exactly what you want for hedging longevity, right? It's not only it not only insures old age, but at an increasing rate. And of course, individual home value insurance is being provided, not just market home price insurance. Nobody buys Case-Shiller securities, unfortunately, but this insures your own home value. And of course, that means you have options to under-maintain your home, to stay in the house longer than you would have otherwise, to really juice up the default option. So I believe it is unthinkable in the workhorse life cycle models that we typically work with that somebody would reject a product like this if they understood it, right? It's insurance and it's favorably priced and it's insuring stuff that matters. So I think a consequence is we have to assume either our models are totally wrong, which I don't think they are, or people don't understand the product. Because, again, market penetration everywhere has been low. Sure, it was more popular in Stockton than elsewhere, but you're looking at like 5 or 8% penetration instead of 0 everywhere else. So here's a figure I won't walk through. These dots and triangles just say a lot of US metropolitan areas, I think these are actually US states. These lines are where is the default option fairly priced. If you think 6% is what you're paying for the option, most markets feature favorable pricing. It got a little bit less favorable in 2000 something after the crisis. There was an adjustment to the loan terms, so you're getting lower loan to values, which reduces default value. Okay, quick point about the US housing crisis. I'm going to make it very quickly. The people who predicted a housing crisis and give themselves credit for it, some of us are prominent in the profession as New York Times writers, said, you know how I know there's a bubble? Because of home prices in San Francisco and New York and Boston. You can't have a bubble anywhere else. That was actually wrong. The places with the biggest home price booms were elastically supplied markets like Phoenix and Modesto and Sacramento and Orlando, and those were the places with the worst boom-bust cycles, which is hard to believe, but also gives you a suggestion. Is it that hard to figure out if you're sitting in Stockton as a retiree with a house and the option to take HECM in 2005, 6, or 7, that, geez, this is a fantastic product because, even in normal times, that graph didn't assume a boom-bust cycle. If I think I'm at the top of a peak, which, how could you get 100% price appreciation in an elastically supplied market? Not crazy at all to think old people might have understood that. And lo and behold, here's HECM penetration on the vertical axis and how bad your home price was on the, vertical is penetration, what fraction of retirees were taking the product. Oh, it's always low, but it's much greater in the markets that had very large subsequent busts. Okay, so it's only in the bubble markets where there's really any significant penetration into the market. It's still low, 98% of people are rejecting it, but the interesting fact is you still get very low penetration in the markets. What markets didn't have a home price bust? These are just dead markets that never see any appreciation under any circumstances, and there's just zero demand for HECM in those, what I'd call Uncle Jesse markets. Okay, put value and originations by year. This shows the time series, so that was the cross-section of bad metropolitan areas. Here is the time series. HECM originations are in dots. Oh God, when do you ever see a market with adverse selection this severe? All of the loans were originating near the top of the peak. And, whoops, yeah, okay, yep, that's fine. And then the vertical line says, how bad would this have been if you hadn't had geographic adverse selection? So not only were loans being originated in the sand states, those bubble markets, Florida, Arizona, California, Nevada, but the share in the sand states grew exactly towards the peak of the cycle. So originations peak and the fraction going to the markets where you don't want to lend it peaks at the top of the cycle. I don't know that there's a market that's ever seen adverse selection this severe. I mean, it's got to rank up there. Okay, here's the key piece of evidence that makes me think, while this is a very scary product, I believe this was accidental. The natural accidental story is, if you're a poor woman living in Stockton and your home price doubles, you don't have to be ruthless to be interested in HECM. It could just be that you're poor, you're a subprime demographic, which is exactly where home prices increased because that was what was driving the cycle, and you've seen huge capital gains. And of course, it's more attractive to take a reverse mortgage when your house is large relative to the rest of your wealth. So you have these poor people in poor neighborhoods who have ridiculous home price gains. It might not have been strategy at all. Here's the test. On the horizontal axis, how much did you borrow in the first year of the loan? And what we know about line of credit use is people so-called set it and forget it. They grab all the money up front and then never use it again. And what do we see? Conditional on line of original use, the dots are the treated markets where people terminated their loan in the money with their house worth less than they could potentially borrow on the line of credit. What fraction actually exhausted their line of credit prior to termination as a function of how much they borrowed in year one? If you didn't use all the line of credit up front, the fraction terminating, having exhausted the line of credit, is very low. That seems to be an absence of ruthlessness. Moreover, they might have exhausted the credit even for non-strategic reasons. So let's look at comparison markets like Boston and New York, which had big appreciation, but almost nobody's underwater. So the exhaustion rates in the treated markets are no different from those in the untreated markets. That is to say, the fact of being underwater does not lead people to strategically exhaust credit. That tells me this isn't ruthless grandma. I'm going to run out of time. Let me just show you, what about selection within markets? Here is, if I use the Federal Housing Administration, FHFA's repeated sale home price index, okay, what fraction of loans end up with the lender saying to the FHA, hey, this guy owes me more than the home is worth? And what you see is this surprise. Lots of people between 80% and 100% seemingly mark-to-market loan-to-value. If you bump the initial value of the home by subsequent appreciation or depreciation of the home price index, you get defaults between 80% and 100% loan-to-value. How could that be? I know how much the guy owed. How could he possibly have defaulted if his home was worth it? Answer, people's homes are appreciating by less than the index. And that could be moral hazard. They say, hey, I've got this possibility of default. Why should I bother fixing the roof? But a lot of this, about 30%, can be explained if instead of using metropolitan area appreciation, I use zip code appreciation. That is, these loans were more popular in zip codes that underappreciated their metropolitan area. And what were those neighborhoods? If you look at it in terms of characteristics, you can explain a lot of the zip code underperformance just by the fraction black or Hispanic. Now, is that minorities save less or minorities are poor? Minority seems to explain the data better than poor, but I think maybe minority might be a better measure of elderly poverty just because of the correlation in the data. Okay, so no evidence of ruthless behavior. People do not use HECM as a pure put. It would be terrifying for FHA if they did, but to predict on optimal design, a credit line would be a terrible idea if you had a ruthless counterparty, but maybe a good idea if you value flexibility. Looks like we don't have ruthless counterparties, so the flexibility may be a wise design choice.